All right, and we're live. I am thrilled to be joined by a longtime friend, Vishal Garg, founder and CEO of Better. Now, Vishal, I've known, I think, for over 15 years. I've known him, I think, definitely longer than I've known my wife.
Oh, totally. I remember when you were still single and ready to mingle.
This was a long time ago.
Yeah.
Vishal's got some dirt on me, it sounds like here. That's a good way to start the podcast here. Vishal and I have done investments together. He's invested in my prior company as well. Vishal took his first company public when he was 26. And what we want to talk about today is founder mode, the future of the mortgage market, how AI is going to transform that, negotiating with SoftBank Masayoshi-san. Vishal has got an incredible set of experience that I think we all can learn from. So thank you, Vishal, for joining us.
Of course, Ram. I'm so delighted to speak with you and everyone listening.
Well, let's dig in. Let's start off with the Zoom viral moment. And I'm sure folks remember this. There was in 2021, everyone was laying off, which was the right thing to do back then. You had ZIRP, interest rates, people got bloated. It's time to cut costs. And, there's a viral moment where you're on Zoom and you terminated 900 people. By the way, I listened to that video in preparation for this. And in my view, word for word, nothing was really out of place. It did lend itself to a viral moment, though, of course. It's on Zoom. Back then, 2021, Zoom stock price all-time high. It was the age of digital management and remote and COVID. You've had some time to reflect on all that. Open-ended question, what was your experience around that? Obviously, you've come a long way since then. Go ahead.
Yeah, no, it's a fair question. Look, honestly, that was not my finest moment. There's a lot of ways that we could have handled it better. We really tried to figure out what were the alternatives. It seemed much worse to actually ask everyone to come back into the office and then tell them that, we weren't going to be able to they weren't going to be able to be part of the better journey going forward. That seemed actually cruel. So we decided to do it over Zoom. And I think the fundamental thing that I got wrong was, I could have hid behind an HR person. I could have hid behind, the folks who ran operations or sales. But I wanted everyone to know, look, ultimately, I take accountability for this moment where our company isn't doing as well as it has been. And, I was, of course, able to take credit for when it was doing well. So shouldn't I take accountability for it when it's not doing well? And then, lead from the front and make the hard decisions and tell people that it was my decision to make that decision. I think ultimately, a lot of that felt still, not the best way to do it to the folks who were affected. I think I should have leaned in and been more empathetic. And I think I've learned from that experience just, that I have to be extraordinarily empathetic, not just to our customers in terms of designing the best product and providing the cheapest rates and being able to, save them money and time and, headaches in their homeownership journey, but also to our teammates. Because in order for our teammates to treat our customers well, we have to treat them well. And I think it was just an unfortunate time. I think the virality of the moment was, I think we were the first to do it. Here, everybody was still thinking things are booming. 2021, things are booming. Things are great. And we as a mortgage company could see that rates were going up and the percentage of people that wanted to get a mortgage refinance, which is the thing that we excelled at. Like in 2021, we did $58 billion of mortgages. That's more than Bank of America did in 2021. And this was a company that was at that time 5 years old. And, but we could see that the customers were not going to get the same benefit from refinancing that they were going to, and we just didn't need the kind of growth in the number of people that we'd had. And so we needed to right size. And look, I dealt with it head on. I learned from it. And then over the past couple of years, I've spent a lot of time working to become a more empathetic, people-centric leader.
Two questions there. First off, why not have the managers deliver the communication via Zoom themselves? You said you wanted to lead from the front. Was there a thought process around that? Or did someone on your team say, hey, Vishal, you got to own this and just you deliver the message to everyone? Like, why didn't the manager deliver that?
to be honest, we had a lot of folks who were relatively young managers and relatively inexperienced managers. They had gotten battlefield promotions. To give you some context, Better went from doing $4.5 billion of loans in 2019 to doing $25 billion of loans in 2020, and then $58 billion in 2021. So, and this is during COVID. And so we had people that were, loan officers who became senior loan officers, who became senior managers of loan officers, who became vice presidents of sales and got promoted so rapidly through this that they had never had the experience of being able to work through these issues. And so from a message getting garbled, if you then distribute that message out amongst, 400 or 500 people to do all at once. The other thing that you have to remember is that we are in a business where there's a ton of customer data that customers entrust us with. We know almost everything about their financial profile, their property profile, their families, and as part of the mortgage process. So when we had to let people go from the business, we had to terminate their access to the systems. So because we didn't want any customer data getting affected. And again, we are a customer first company. So we did what we did because we were focused on being a customer first company and making sure that there was never any problem with a customer experience or customer data, that there were no hiccups in that process when we did it.
Yeah, no, I think legal and compliance is another consideration. The first time I had to let someone go was in the 2008 crisis. And, it came from the CFO of, Merrill was like, Ram, you've got to let someone on your team go. Doesn't matter who. And I wasn't communicating that way. Just came like, here's a headcount number. Your target is to get to this number. We don't care how you do that. It's like decentralized leadership. And I had a first-rate, world-class team.
Right.
And my HR sat me down. I was 27 at the time. And they said, you cannot say, I'm sorry that we have to do this. I regret having to do this. You cannot give any indication that exposes the company to any liability. So even though your heart is in pain, you really can't say much at all. And when I did it, the person on their side started crying in front of me. And this is my first time again. I terminated. Like they went through a lot worse than I did there, but still, So I think people don't necessarily appreciate like there are compliance and legal considerations around this, and you have a fiduciary obligation to uphold that to protect the employees, the customers, and the shareholders. So let's move forward. So you negotiated a deal with SoftBank, Masayoshi-san. What was that like? How did you negotiate that? And what advice did he give you? We'll unpack that one by one.
So working with our partners at SoftBank has been an amazing experience. When I first met Masa back in January of 2021, the company was absolutely on fire. We had grown 850% in 2020. We had done about $25 billion of loans. We generated over $880 million of revenue and $250 million in adjusted income, right? And so, or EBITDA. So we were on fire. And in Jan, Feb, and March of 2021, we generated an additional over $100 million of EBITDA. So we were just accelerating. And fundamentally, what I shared with Masa was the vision for Better, which was that fundamentally there are 8 billion people on this planet. Only 7 billion or so even own a home. And so fundamentally, and the biggest challenge to owning a home is being able to afford it. It's the object of desire of every man, woman, child in this country and everywhere in the world. And so if we could create a mechanism for providing financing to consumers for their biggest life purchase and their biggest category of consumer spend, and we could match that to investors like we have done, in the US, and then eventually do that globally, right? In a capital light model with good unit economics, we could make 1% a year over time on that asset. And so we created a way for us to, and what we had done in the US, we were on our way to doing over $100 billion of mortgages entirely digitally, the first of any company to actually do that and do that volume. and to do so while giving the consumer a lower rate and giving the investor a better loan, right? One that defaulted less, one that had less origination defects. And so the matching engine between land, labor, and capital probably is something that would be very, very valuable. And I don't know how much that's worth, but it's something that in the largest single asset class in the world, 140 trillion, 39 trillion in the US alone, in the mortgage market, which in the US alone is 15 trillion, right? If you could create a matching engine that does that, then you would create a very valuable company. And I think that's the vision that I laid out for him. And 15 minutes into the conversation, and we shared how we were doing it. And 15 minutes into the conversation, I think he was not more than enamored. He was sold. And the rest is just sort of history. And since that day, they have stood by us. They have backed us. Masa did an earnings presentation back in 2021 where he talked about the future of AI mortgage, and he talked about Better. And I think that future is still going to come. I think that future is still very, very bright. We've just had the worst possible macroeconomic environment for mortgages in 50 to 100 years. And we have lived through that with the support of our partners at SoftBank. And we're really excited for what comes next.
How did you get the access to Masayoshi? So was it intro from an existing VC or?
We had actually spoken to SoftBank multiple times before and pitched their team. I think they reached out to us through one of our existing investors and board members who's been an amazing partner, Steve Saracino of Activin Capital, and then we got started in speaking to them.
How did you negotiate price and terms? So he loves you. He wants to do the deal. A partner nominated you. It's how you get to talk to Masa. You don't get to Masa unless you've gone through the gauntlet. So at that point, he wants to invest in you. How did price and terms unfold from there?
I think we priced it at that time based on our numbers on a very reasonable multiple, right? You had a business that was, when we were talking about pricing, I think in February of 21, we were making $50 million a month in cash flow, right? So you multiply that by 12 and, we did a deal at an $8 billion valuation, a very reasonable multiple. I have a fundamental belief that you need to help investors along the way make money, right? Every round that we did, we never priced it to the absolute hilt of what the market would bear, but we priced it to what would enable us to get the most strategic and best investors on our platform. That's why we had, we didn't have a venture capitalist lead our Series A. We had Goldman Sachs Principal Strategic Investments lead our Series A. Then Kleiner Perkins led our Series B. Then we had the Health Plan of Ontario, Ally Bank, Amex, City Ventures in our Series C. Yeah, all world-class investors.
Yeah, especially.
Yeah, world-class investors that provided us true tangible benefit other than just the money.
Yeah, I mean, Goldman Principal Strategic Investments is far and away the best strategic investment group across all the investment banks, led by Darren Cohen. And you've got Ally Bank in Ontario. It's world class. So what was the nature of the negotiation itself? So I get the approach in terms of how you valued it. Was it a phone call? Was it back and forth via an email? Like who led the offer?
I think it was phone calls, and I think it was phone calls, and then my team, my CFO, and our head of corporate finance, they managed the process of making sure that the deal got done. And ultimately, during that time, I knew that between the time that we agreed the deal and we actually between when we started talking about it and we agreed, the company continued to do well, and I think that was important.
That's the best. I mean, I think good little founder tip here. Many of our Lumida's clients are founders, exit founders, but when you're talking to a VC, that's a process. It actually starts 9 months before you raise money, usually with a cup of coffee and establishing a relationship, make sure the vibes are there, and introduce the concept on their radar. But once you're actually doing a raise, there's a 30, 60, 90-day period that's going to take place. That's 30-day period. That's called top of the market 2021, when things are really hot. But it's a 9-day process. And it's helpful to know what are the catalysts and the milestones that'll happen while you're doing the race. So knowing where you want to be from your sales target, what are the key milestones you're going to be able to introduce and announce to the VC to show those dots that are generating a line that's going up and to the right. So you have
100%. Yeah.
you had a machine, you had a mortgage origination machine.
We had an amazing machine, and we were delivering real value to American consumers, delivering real savings, and the investors were clamoring for our product, and we were able to demonstrate consistent growth through the entire period of the negotiation that was taking place. And I think that was all of those things just validated the thesis that the investors had in the company.
Right on. Now, look, this is the second company that you've taken public. And the first, you were a Stuyvesant High School grad. So I look at that as a compliment. I mean, you know,
thank you.
It's one of the top schools in New York City, which means the world. Highly driven and motivated at a young age. Let's double click into founder mode. I mean, you have certain traits about your personality. You're intense, you're sharp, you're driven. You know, what was your journey from Stuyvesant to your first, public company exit?
So at Stuyvesant High School, we were surrounded by people who were really good at everything and then amazingly spectacular at one thing. So whether it was physics or chemistry or biology, people that we thought were my friends, and they were going to go and win a Nobel Prize someday or going to do some groundbreaking research someday. And I wasn't the best mathematician. I wasn't the best scientist. What I was really good at was synthesizing what was happening in the world and trying to come and forecast events and predictions and come up with an understanding of what might happen next. And I thought that might be useful, like in journalism. I thought that might be useful in politics. And I think those things are great professions, but the one challenge with both of those professions is they don't pay really well. And so what coming from a very middle-class background, grew up in Queens, New York. When we first came to this country, we lived in the basement of a house in Queens, and over time,
were you the son of immigrants?
Yes, I came here when I was 7, so I was born in India. Came here when I was 7, and so one thing I wanted to have in my entire life was upward economic mobility, and I wanted to and in order to have that, what I found was, really early on, I was able to get a job working at a small emerging markets hedge fund. Initially I was an intern there, and then I grew to actually being an analyst who was analyzing companies all across the emerging markets, companies that were at that time privatizing and liberalizing, companies that had a ton of potential but were really not well understood by the markets. And this is like the mid 1990s. And so what you could do is go and do really deep research and find these companies that there was not a lot of data on or analyst coverage on, and then invest in those companies, and then, effectively work with the brokerage firms and others to kind of get research published on them. And then from there, ideally, be able to generate profits and generate surplus alpha, and then go from there. So what we called at that time the discovery premium, right? And I was able to do that, and I did quite well doing that, and that led me over time to being an investment banker, because I wanted to start to understand private companies and larger transactions. I was an analyst in the M&A division at Morgan Stanley for a brief time.
You were you overlapped?
Yeah, and I actually, it was interesting because I got staffed on a deal with Mary Meeker to work
on the equity research side. You're on the banking side.
Yeah.
And was this before the separation of
before the separation, right? And it was funny because Mary Meeker would later on go on to invest in Better and lead the Series B, but along with her partner Noah Knopf. But in the context of 1998, we were pitching a company that was like the Yahoo of Latin America. And I was 21 years old and, hauling the pitch books, and they were in a loft in Flatiron. And we went to see them. And I was like, these guys are not that much older than I am, right? And before the internet and before the dot-com boom, everyone had said, if you want to start your own company or if you want to have your own fund, if you need to be, have 10 years or 20 years of experience doing this. And here the internet was all new and no one had experience in the internet because it was completely new. And so you didn't need that experience. So I decided the day after that I'm going to quit and start my own company. So I left the analyst program at Morgan Stanley. At that time, I was like about 8 months into it and said, I'm going to quit. Wow. And I didn't have a plan and I wanted to start my own company. And then I went around.
First gig out of school too.
Yeah.
So you're 8 months into a highly sought after analyst program that people would clamor to get. Morgan Stanley Tech Investment Banking. You're getting paid well. 8 months in, you're talking to someone in Flatiron, and you're saying, all right, I think I can do this too. I'm out.
I fundamentally thought that the entire premise that I was operating under had been wrong, that I have to spend 20 years learning how to do something to go start a company. And so when I'm wrong, I pivot really hard, right? Like I'm not afraid to admit that I was totally wrong.
That means you're a great trader, right?
Yeah, the premise was wrong. And now I have new data and I'm going to go and capitalize based on the new data. So, I quit and, someone asked, I started asking around, what are interesting things and what are different interesting companies or spaces where there's, a lack of focus on the internet. And one of the things that I found was someone's like, it's really helpful to start a company based on a problem that you have experienced. So if you've got lived experience with a particular problem, that can create a really good place to start a company. And so, I was a scholarship kid in college, and I always wondered, how hard is it to get money to pay for college? And I had a lot of friends from Stuyvesant that had the same issue, right? They went to a state school instead of a fancy Ivy League school because that was what they could afford. And so I thought that was fundamentally unfair. And so I started a company called myrichuncle.com. And My Rich Uncle would give you a loan to go to college. And they would base that loan not based on your parents' FICO score, which is the way that loans were done before, that you had to have a parental cosigner in you, but based on what you were studying, how much money you were going to make post-graduation, and what your career path was going to be. So what we called the MRU score at that time, the My Rich Uncle score, which is like, are you going to be successful in your future career and have the ability to have your future debt to future income ratio be something that an investor might find attractive? And when we launched My Rich Uncle,
it's just a SoftBank pitch now, which is phenomenal. I mean, you were building a fintech company before fintech as the category really had come into its own. I mean, there were a few VCs out there like QED and Oak, HCFT, and maybe like that's it. I might be missing one, but you were an OG fintech entrepreneur.
Yeah. I started a consumer finance company leveraging technology in 1999, right? And there was just very, very few companies out there. My Rich Uncle took off. We got a ton of kids to apply. Getting the capital was a little harder. We eventually realized we needed to raise a lot of money because at that time you couldn't just, there was no marketplace for loans. That hadn't been created yet. The idea of personal P2P lending wasn't there yet. So, we originally thought we would try to create a market for loans, but then we actually had to just raise the capital ourselves. And we ended up raising over $100 million of equity capital, ended up getting, owned in part by Lehman Brothers, in part by Merrill Lynch. They took strategic stakes in the company. And I was able to take that company public when I was 26, persevered through many ups and downs. It was just an incredible ride.
You went through the 08 crisis, which couldn't have been fun non-banking lenders in general for a while.
Oh, everyone was getting shut down. Yeah. So ultimately that's what happened. Everyone got shut down.
Right. Although I did meet an investor once who had a yacht. Did you know the story? Of course you do. You hear everything, right? The yacht was titled like My Rich Uncle or MRU or something like that. So,
I don't think so. That wasn't mine. Not mine at all.
Someone did pretty well there. At least,
there were a bunch of investors that did well in that company.
Right. Now in 08, you pivoted and you started investing in distressed securitizations. Do you want to double click on that story in that chapter?
Yeah, sure. So after My Rich Uncle wound down, I was wondering, okay, what to do. And, the market was completely frozen for any type of loan product. And investment banks were trying to get these securitizations of loans that they had purchased from their customers or that they had gotten hung with off their books. And so I discovered that one of the banks that owned the securitizations that I had just done at My Rich Uncle was offering to sell them to investors for 40 cents on the dollar. And so I was like, wow, that's amazing. Like something I just sold for 100 cents on the dollar is now trading for 40 cents on the dollar. What exactly is the challenge? And what I discovered was fundamentally these folks at the big banks, they were entirely driven on a methodology for pricing securities based on their credit rating. So they weren't looking at what the underlying loans in the securitizations were. They weren't looking at what are the attributes of the people that had backed those loans or who owed those loans. They weren't looking at the underlying real estate they owned. They didn't look and understand what schools they had gone to. And so I saw in a similar opportunity where I said, well, if you actually just go do the research rather than just saying this is, a AAA security that was now, a triple C security and therefore trades at a 15% yield instead of a 5% yield, you could actually instead understand what was inside those securities, who were the obligors in those loans, and re-underwrite them and figure out whether that security was mispriced or not. So that's what I started to do. I started to go in and understand first student loan asset-backed securities. And we started working with banks and hedge funds to actively go and buy these types of securities. And we got to a book of about $1 billion of pools of loans, underlying student loans that we managed. And then from there, we started looking and people started saying, could you do this for mortgages? And so we said, yeah, I can do this for mortgages. I can apply a similar, thought process, just work harder, work smarter, and understand what's going on with the underlying collateral in these mortgage pools. And we started to do workouts of mortgage pools. And ultimately, I created a business that got to about $6.5 billion across all the different vehicles that we were managing. And it was an incredible business. And, that was the business I was doing before, Better came along.
It was a really cool business. I got to meet people on your team. Now, you've always done a fantastic job at attracting quality talent. I remember just talking to different people on your team that we both know together now as friends, and just high caliber people all around me. Something people don't know is that more money was made on the big long than the big short, and you were part of that. You were buying the 40 cents on the dollar, and maybe it was worth 90 cents or 80 cents.
Yep.
And a lot of those senior bonds actually recovered to par, in part because they were backed by house prices, housing collateral, and house prices went up. So securitization worked, not a lot that didn't work, obviously. And there's still a lot broken today. You still don't have loan level transparency on privately placed securitizations, and things are still summarized at the aggregate, what's called a rep line level. I just showed a moment ago a picture of Michael Burry from The Big Short crawling along the floor trying to figure out the fight scoring a loan. So you had the analytics to go do all of that.
Yeah. I had the experience to know how to get the data from the credit bureaus to how to get the data from all the property transaction records, and that experience, and then just the willingness to do the hard work of aggregating all these data sources, getting them in the right database structure, and then figuring out how to mine that data to make sense of what was in the underlying pools.
Right. You were doing data apprention, data enhancement. You weren't relying solely on the loan tape that was provided to you. Like you talk about the property record. How do I find more information about who this borrower is or this asset so you can make a better decision? Totally. So there's clearly a continuity in your career around these two things with your fintech lender, My Rich Uncle, and the mortgage market in 2008. So let's talk about Better Mortgage now. Now, what's broken with the mortgage market? You alluded to some of this initially around the experience. You talked about this matching algorithm that you have. And for the folks that don't know, the primary buyers of mortgages are Fannie Mae and Freddie Mac. These are under conservatorship from the U.S. government. How are you changing the way mortgages are bought and sold?
Totally. I think the first thing, what I saw in the mortgage industry was really remarkable. My first experience with mortgage and getting a mortgage was back in 2013 when, my son was getting a little older, painting up the walls on my bachelor pad in our rental apartment in Manhattan. And the landlord was upset about it. And so we said, no, we need to get our own place, get him his own nursery, build a home for our children. And so something very similar to probably what a lot of folks have gone through, and, just this desire to own your own home. And I found the place I wanted to buy on Zillow. I went to the open house and I told the broker, this listing broker, hey, I'd like to make an offer. And the listing broker said, well, okay, how much? And so I told him the amount. And then he said, well, are you going to, finance it? I was like, rates are really low. Of course I'm going to finance it. Right. And then he's like, well, are you pre-approved? Because I can't accept your offer unless you've got a pre-approval letter. And I was like, well, what is that? And that was like my first instance of, oh my God, here I am managing a pool of $5 billion of mortgages, but I have no idea what a pre-approval letter is and what is required. So I go online that evening and I try to go get a pre-approval letter online. And it's impossible. I'm getting called by all these different people from different mortgage shops, different mortgage brokers. They all want me to give them my social security number and my income and all this other stuff on the phone. And I'm like, isn't there a secure online form that I can fill this in? Like, how do I know that, someone is trustworthy? You just got my lead from, some website. And I was surprised by how backwards the process was. My wife at that time was working at Citibank, where she was a senior executive. And she then said to me, well, why don't we go and do this program that Citi has for its own employees? So then we went to go to a Citibank branch and we had to schedule a meeting there. And we went through the process and, they were asking me like all my information. Then we're asking my wife, how much money does she make? And they were asking my wife, where does she work and all this stuff. And I was like, wait, isn't this all this information on some other floor, on some other database? Shouldn't you be able to port this immediately? And yeah, exactly. Right. Yeah. Like, no, our bank accounts are there, all this stuff. Right. Like, and it was just surprising to me that we had created a way to price any loan inside any security of residential mortgage-backed securities. And we could do that instantly. And the process of getting a mortgage took months in America at that time. And so what we did, I was just like, if I'm going through this, how many other people in America are going through this? And, there are like 7 million people a year in America that are going through this process. And it's opaque. It costs a ton of money. The average mortgage in America today costs about $10,000 to manufacture. It's composed of 800 pages of paperwork.
Closing costs, title costs, broker fees.
Closing costs, title costs, appraisal costs, all these costs. All this data being shuffled just back and forth. And so I thought, isn't there a way to make this process and the process of getting a mortgage much, much faster and much, much easier? And that would add certainty to consumers. They would know exactly how much they could afford. They would then be able to buy a house that they could actually afford, which would enable them to have better performance on their mortgages onwards, right? A cure for the credit crisis so that it doesn't happen again. And then 3, it would provide more liquidity to the market because sellers and buyers would be more certain about their ability to close. And it wouldn't take 60 days and, a quarter of transactions wouldn't drop off because of financing issues and things like that. And so I went out and I tried to, talk to people who own mortgage companies. So I went to go see a bunch of mortgage brokers, or mortgage lenders. There were some mortgage lenders that built their business on relationships with realtors where they got referrals. There were other mortgage lenders that bought leads from like Bankrate or Lending Tree and tried to convert them. There were other mortgage lenders that, play to a particular ethnic group or any of that sort of stuff. And each of them had their own issues. One of the biggest problems was a lot of the mortgage lenders had been through the credit crisis and had, at that time, still liabilities from putbacks from banks that they had sold on their mortgage pools. I finally found one of my friends, his parents owned a small mortgage company in California that was mostly doing mortgages to recent immigrants who worked in the tech sector. And basically, as soon as they came to the United States, they finally got their green card, they'd want to buy their own home.
Segment. Right.
Yeah. So great segment, super awesome credit, super awesome income, really clean. And I went and spent 3 weeks there trying to figure out what they were doing. And there were all these processes that were being done where they were taking information, writing it down on a yellow sticky pad, then giving it to another person, putting it all in a manila envelope folder, and then transferring it from person to person, and it was like 8 people that a file had to go through, someone pulling income, someone pulling credit, someone calculating the debt to income ratio, someone, pulling AVMs or like valuations of houses, someone calculating the loan to value ratio. And I was like, all of this should be done by a machine. And all of this should just be in one flow. And all of it can be done nearly instantly. So we rigged up a prototype and we said, can we turn this process, which today takes 3 weeks of getting a pre-approval letter, into something that would take 3 minutes? And that's how we launched what is now known as Better.com.
I had an offer from Better Mortgage during COVID, so thank you for that. I locked in a 30-year fixed rate, 2.5%. I told my wife we're never moving. Well, 2.5%, or 18 years passed, and our principal investment P&I paid down substantially. But
thank you for being an awesome customer.
No, it's been a great experience. So this matching algorithm I find super, super interesting because there are significant parts of the mortgage market that are underserved. And as you know, there's the agency mortgages. These are conforming mortgages that, if they're under a certain balance and it meets a certain LTV and a minimum FICO score, and you kind of have this straitjacket of criteria there, you get a mortgage, and it's efficiently priced, and Fannie Mae and Freddie Mac are the buyer, and it goes through the mortgage-backed securitization machine. Now there's this other part of the market. For example, the part of the market that First Republic was in, jumbo mortgages, or it's like Puerto Rico. Puerto Rico, you can't get a mortgage. You can get a mortgage from Banco Popular, most significant bank in Puerto Rico, but it's a conforming mortgage. And we've got high net worth customers in Puerto Rico that don't want a conforming mortgage because they've got a $20 million house. They need to do better than an $800,000 Fannie Mae Freddie Mac mortgage. So who's solving that problem? Is Better focused on that? Are you able to match those loans to?
Yeah. So we've got over 32 different investors on our platform. And fundamentally, the challenge is not just the Fannie Mae, Freddie Mac, FHA criteria. The fact is that different investors in the market, different servicers in the market overlay criteria on top of the Fannie Mae, Freddie Mac, FHA criteria. And then on top of that, there are products like non-QM and jumbo. There are products that don't have Fannie Mae, Freddie Mac criteria, like home equity lines of credit. And what we realized is we could create a platform that would take in customer data, so customer attributes and property attributes, and manifest what we call the customer financial graph and the property graph. And basically taking all those attributes, we would have processes that would go to third-party data sources, verify the attributes that are entered by the consumer, or fetch the attributes that are required from the investor automatically on behalf of the consumer, and then effectively take the criteria set forth by all of these investors and the resultant pricing based on that criteria from all these investors and effectively match it together.
So
and
you
create
run an
both.
Auction, or how does that work?
We run an auction on every single loan.
Okay.
We run an auction on every single loan that we fund.
Is it a trade by appointment market, or what are the dynamics of this auction? Because those loans are bespoke and they're not necessarily standardized when buyers and from buyer criteria.
But when they go through the Better platform, they become standardized and they get matched. And then we have agreements with those investors that if we fund a loan with this criteria, they are required to purchase it from us. And so that is how we've built a business that's done over $100 billion of loans while retaining $0 of loans on our balance sheet.
Right. So you're not putting your capital at risk, and you rely on the reps and warranties of the borrower the risk is of fraud, but fraud, the borrower is held liable. So, and then you can fund quickly and deliver a quality customer experience because you know what the buyer is willing to pay. And what are the entity types on that platform? Are they private credit funds or regional banks? Like
we have mortgage REITs, we have regional banks, we have private credit funds, we have securitization desks of investment banks, we have Fannie Mae, Freddie Mac, FHA, VA. We have the broad cross section of the market because what we wanted to create was a company and a machine that could serve the broadest cross section of the American population out there and enable for the highest approval rate that anyone could come to. So they wouldn't have to go to Regions Bank or Citizens Bank or Wachovia or somewhere else, where they only deal with one credit criteria, but they could get the credit criteria basically of all the leading banks and the REITs and the mortgage companies and the investors all in one place. So they have the highest probability of getting approved. Two, because we are able to digitize and then leverage AI to automate the bulk of the process, they could get speed. So instead of taking 45 days to get a commitment letter, they could get one in one day. 85% of our mortgages today are one-day mortgages, where a consumer is getting on an average of 8 hours, getting a turnaround time on a commitment letter. And they could get a really low rate and save money on their largest financial outflow per month.
There's value on both sides of the marketplace. You get a competitive auction that delivers a rate in a convenient manner. You're selling painkillers, not vitamins there. And on the other hand, for the lender, you're aggregating loans that meet their criteria for them, and you're doing an electronic format. That makes a lot of sense. What's the volume or mix across these mortgage products? And I got to imagine Fannie Mae, Freddie Mac, that's got to be the vast preponderance, but are you seeing shifts and trends in that data?
Yeah, so based on today's volume, about 80% of our product is conforming mortgages, Fannie Mae, Freddie Mac mortgages, right? What we try to do on top of the traditional Fannie Mae, Freddie Mac criteria is we include criteria like CRA tracks, other fair housing considerations.
Community Reinvestment Act. So can I qualify by buying your CRA product if it meets my kind of geo zip code zone per the bank?
That's exactly right. So what we do is we deliver like CRA as a service to the banks, right? Where if you're a bank and you are light in a particular geography, right, we can originate mortgages for you in that geography. We can take the CRA subsidy and manifest it in the form of a lower rate to the consumer, and then originate more mortgages in that market.
Two observations. One, I think the Community Reinvestment Act, which was created in the 1970s, is antiquated, should absolutely go away. But it's used to bludgeon banks in different kinds of ways, and it's bad. But you've got a fantastic business model. I hope you're selling those loans above par.
Yes, we sell all our loans above par. Yeah.
Oh, of course. That's it. So you make your money by selling them above par as opposed to a transaction fee.
Yeah.
Gotcha. Okay. Hopefully those loans
but we get paid extra for the CRA loans. And then what we do is we take a portion of that money that we get paid extra and we give the consumer a better interest rate and lower fees as a result of that. And so it's an amazing expression of translating the capital markets and all the vagaries of the capital markets back to the consumer in the form of savings online.
The other questions start to emerge, like when do you get dynamic securitizations? And you know this, you know exactly what I'm talking about. How do you fill up the securitization tranche instead of selling whole loans? Because usually the constraint is finding the first loss capital, which is the scarcest form of capital in the world. It's the bottom of the securitization waterfall. They're first in line for losses. Generally, the owners of that are hedge funds. So is that in the offing at some point? Is that part of the journey for better?
It is one of the things that we're working on. A number of large private credit funds have approached us and said, hey, we have demand for this type of product. Can you originate it for us? And then we can go out into the market and market to those types of consumers, give them, an easy online way to get those mortgages, and then effectively deliver that product to these big credit funds.
Is there an opportunity to tokenize these mortgages or use digital asset technology to create more transparency?
We have worked on efforts to figure out how we can tokenize these mortgages. I think the clarity around whether tokens are securities or not, and what is required is likely to get better now in the new administration.
Sure.
And then you'll see us lean forward into that in a much more aggressive way.
Got it. Makes sense. Now let's talk about the AI component. So you've got this AI tool called Betsy. What's that about?
Yeah. So I think fundamentally, the manufacturing cost of a loan in the US today is about $10,000, of which $7,000 is just the people cost, just the labor cost. Of that, the biggest component of that labor cost is the loan officer, right? The salesperson. And in a typical mortgage company, a salesperson might get something in the order of 1% of the loan balance. So on a $400,000 loan, the salesperson's earning about $4,000 on a typical mortgage company. Now, we have created a better mousetrap, but ultimately one of the challenges with sales folks, even at Better, is they can't be up 24/7, 365 days a year. And consumers, they want to transact on the weekends. That's when they go try to buy houses, or in the evenings when you and your significant other might be talking about, hey, buy this house. How are we going to pay for it? Let's go and get financing for it. How can we do that?
It's the on-demand economy. We want our food,
That's right.
Push a button, Amazon Prime delivery. I want a mortgage real time.
Yeah, you want a mortgage. I need it to be in real time. And so we've always struggled with being able to staff for the hours that the consumers are there. Now, one of the beautiful things about what has happened with generative AI is that our platform, Tin Man, which is the matching engine between the consumer, the property, and the capital markets, is built in a data structure that is extraordinarily easy for AI and particularly LLMs to interpret and make sense of. And so what we have been able to build, and we've been working on it for about 9 months now, is not a chatbot, not a chatbot that is a glorified version of an FAQ, but one that actually is able to capture data from consumers, process that data, and move them along in the mortgage process, much like a loan officer would.
Like a loan officer.
Yeah.
And potentially they can interact on the service layer and talk to the customer.
Yeah.
So you replace, filling out forms and say,
yeah,
hey, Ron, what mortgage looking for? How you doing today? Oh, you live here? Okay, tell me about your income, this and that, and what you're looking for, and fulfill for the customer. So super cool. That's the future of mortgages. You mentioned Tin Man. That's a Wizard of Oz reference.
Yeah. It's the robot, right? It's
the robot,
and then we've got the
that guy.
Yeah, and then that orchestrates it all, and then we have our people who provide the heart of Tin Man.
Oh, I see. Right. So that's being empathetic.
Yeah.
You bring it full circle, right? Vishal has been a friend and a mentor to me during my entrepreneurial journey. Now and then you would send me text messages around the Jungle Book. So I'm a big fan of stories too. We both have small kids. What are some of the lessons entrepreneurs can learn from the Jungle Book, if any?
I think, the Jungle Book was a book that was written in different times, right? And, a lot of it is not applicable to the way that the world works today. But ultimately, I think, so particularly in startups, it's do or die every day. And you have to bring that intensity of the fact that today you're alive and tomorrow you might not be. And I think you have to bring the mission and the sense of purpose that allows you to thrive in that kind of environment. And what you ideally need to understand is that it's in the startup business, it's a jungle out there, right? And ultimately, it is survival of the fittest. And while that might not apply in all walks of life, might not apply in all other businesses, or might not apply in college or in school or things like that. But when you're running a startup or a young company and a promising company, there are typically many others like you that are approaching the
No
same
ideas
problem.
are original.
Yeah.
Everyone has
No idea is original.
Like PVC knows that. You see 50 pitch books of the same concept. It's a zeitgeist.
Yeah. So ultimately, it is survival of the fittest, and and you have to do what it takes to win. And so it's who wants it more, who's willing to work harder for it, who's willing to work smarter for it, who assembles the largest group of friends and partners that are aligned with that mission and that purpose, and who delights the consumer the most, because ultimately the person that pays all the bills is the customer. And so, those are the things that I think are hold really dear, and a bunch of them, you can learn in the Jungle Book.
Yeah, look, I mean, the top 10 companies by market cap 20 years ago are just not in the top 10 by market cap today. The American economy is one of the few economies globally that's demonstrating productivity growth. And you look at the S&P 500 versus other international markets, you can pick a market. Europe is lagging, Japan is lagging, South Korea is lagging, Latin America is lagging. And it goes to American management. And part of that is a culture of urgency and getting stuff done, and a mentality that complacency is the enemy. Yeah. So founder mode is back on the upswing again. 2021, everyone got fat and happy with a QE and low interest rates and stimmy checks. That was the other side of the pendulum from founder mode. I think entrepreneurs and investors listening to you can learn a lot from what you have to say here. How do you instill that culture? Like, the founders have the most intensity, and they set the tone, and they drive the urgency. And when you find someone that shares that intensity and urgency and drive, at least in my experience, I just want to hug them and reward them. But people don't know that on your team. Like, you can tell them that, but they necessarily won't behave like that. People don't value equity necessarily the way they should. They value cash just fine. So how do you push down that intensity? I mean, you can set expectations up front before you hire them, but people say all sorts of things during an interview process. Then they're in the door. Then there's transition costs. How do you manage to a shared level and shared standard of urgency, drive, and intensity and focus?
I think there's a couple of things. One, you have to always bring it back to what matters most, and that in our case, it's the customer. The customer is entrusting us with life's most important financial transaction, and we have to be there to close for them on time, right? So we close on time 99.9% of the time. That is unmatched, right? And so when you look at that, we say we are driven by delighting the customer and delighting the customer within a specified time frame, which is important to them. So I think that creates urgency. The second thing is again, what is being lived by senior management? Is senior management in the trenches with the troops? Are they in the office? Are they showing up? Are they there? Do they make themselves available? Right? Because that sets the culture.
Do you have an in-office culture?
We are 5 days in the office.
I think that's the right move. If you're building a world-class business, you got to have that. That's how you lead by example. It's how you train the next generation. It's
how the synapses fire, and you create synergies, and people exchange ideas, and you grab lunch, or you talk to someone and you hash things out faster versus like, I can only meet a Tuesday at 1, and I can only do Thursday at 3, and then things go by for 3 weeks before people resolve them. No, you see that sitting in an open office floor plan, and you walk over and you say, hey, can we just hash this out?
I think the best work from home policy for a startup is 5 days in office, 2 days work from home. That's called the weekends. So that's the mentality you need at a startup. If you want to build something great, if you want to be part of a journey that has a chance to have real impact, because there's a lot of discovery that you have to go through. Like you mentioned, the learning process about the customer. What's the right experience? What do you prioritize? What do you focus? Well, this has been terrific. I guess we can conclude on the last topic, which is, what do you think the impact is to consumer psychology with lower mortgage rates, or just in general commentary on where we are in the economy and the consumer?
So I think we're in a place right now where people were hoping for lower mortgage rates out of the first rate cut in September, the 50 basis point rate cut. Rates were down to 6% for a 30-year fixed rate mortgage. And then after the rate cut came, rates shot up to around 7%. On the back of, people thinking that there's going to be continued inflation, tariffs, other things like that. I think it has a major impact on mobility. And mobility is core to the American dream. So what
kind of mobility? Income mobility?
Being able to move for somewhere else for a job, being able to afford a home, being able to show your kids that you can buy a house for them, right? All these things, it just gets as you have this high interest rate environment created by this inflation that was created by, pumping trillions of dollars of freebies into the economy, due to COVID, right? And, and just keeping on feeding the economy. So you had inflation that was sort of manufactured by bad policy choices. And the time that it's taken for that inflation to fade away has been longer, right? Productivity is still lower. It's still hard to find people who want to work certain jobs. All of these things, which have an impact on wages, which then, has an impact on inflation. All of that over time will dissipate. And I do think rates, and, they call it the R-star rate, right? Which is the neutral rate. The neutral rate suggests that rates are going to get back down, from this year to next year to the year after by about 200 basis points. And as that happens, the economy is going to normalize. People will buy and sell houses again. People will refinance. People will take out cash out refinances. And I think the consumer will feel a whole lot better. And I think as part of that, where we are today as a company, we'll be probably one of the prime beneficiaries if you believe those things are going to happen, because we've built a moat and, in being able to offer consumers something that they love. It's just that the market for it has evaporated.
Well, origination volumes will go up. That's one. Number two is you'll see some increase in refinance, but you need to see a significant step down in rates for that to happen, because a lot of people like me termed out their mortgage at a low rate. But on the margin, you should see more mortgage volumes.
You're going to see a lot of cash out refinance. So maybe not like your demographic, but a lot of, Americans have tens of thousands of dollars of credit card, auto loan debt, and other debts that they can consolidate into a cash out refinance and save a significant amount of money. And they're sitting on 29 trillion of home equity, right? And they're looking for ways to tap it. It's just been unaffordable for them to get a cash out refinance until rates go down a little bit more.
Would they look at?
Yeah, they can get HELOCs, but HELOCs are much tighter underwriting criteria than cash out refinances, which are backed by Fannie and Freddie and the FHA/VA, right? The HELOC market is really a prime, super prime market right now. There are HELOC products that are coming out for the broader cross section of the American consumer, which we're working with. But I think, HELOCs are not nearly as prevalent as they used to be before the credit crisis.
And the constraints on HELOC, is that buyer criteria driven or is that regulatory driven?
It's investor criteria driven, because the bulk of HELOCs today are still securitized.
Got it. Makes sense.
And so people are still applying stress levels from the credit crisis. Rating agencies are still applying stress levels from, the crisis type of losses that took place. And a lot of those losses took place because the origination was fraudulent, not necessarily the credit. And so, on a like for like basis, I think the securitizations are still very, very risk averse. And of course, that means that, most people today are not able to get a HELOC.
Well, they're risk averse for non-conforming mortgages, for QM and for jumbo. Obviously, Fannie and Freddie Mac mortgages, that's an efficient market.
Yeah.
Okay. Although the spreads on those mortgages versus a comparable duration treasury remains wide.
Much wider than it's ever been.
Probably one of the best adjusted return investments you can make if you're looking for income in your portfolio, in my view.
Yeah. Where the spreads between the Fannie paper and, the 10-year are much wider than they have been. A lot of that has been a function of the Fed, running off of its balance sheet that it built up during COVID and not reinvesting. Not reinvesting the proceeds back into new Fannie issuance. And so, the market has widened, and we expect those yields also to come down. So, interest rates can come down on mortgages from two factors. One, just the 10-year treasury coming down, but then secondly, the spreads coming down between the mortgage rate and the 10-year treasury. And so I think that double effect will have a pretty meaningful impact on the mortgage business over the coming years.
Right. Hopefully that helps unlock housing and gets the housing market going again. Obviously, home builders have done very well. Well, any concluding thoughts, Vishal? I mean, you're a father and an entrepreneur. That's another interesting topic. I want to respect your time, though. Any advice you have for people that are raising families while you're building a business?
I always found time to go home and have dinner with my kids, and then I would just get back on it. And it would be, I never lost the intensity as a result of that. I would, work from, 8:30 to 6, go home for an hour or two, and then get back on it. And, it was one of the best things I ever did over the past 10 years, because I think had I not done that, I would have missed out on my kids growing up. And that's been an incredible thing. And it's affirmed my belief in home ownership, to democratize it and to bring it to everyone, because, it's amazing what happens to a kid when they have their own place.
Yeah, I mean, it goes back to psychology. I think psychology is foundation for markets and personal development and self-leadership, and pride of ownership is a real concept.
A place to call home.
A place to call home, identifying with something called a home that has some stability. Yeah, that's a big deal. So it's a noble effort that you're contributing to. So thank you again for this. We'll have to do it again sometime. I appreciate everything you had to share with us. Until next time, Vishal.
Thank you so much, Ram. Thank you for everyone for listening. Really appreciate it. Take care. Bye.
If you want to follow for this podcast, listen to later, you can follow on YouTube, Spotify, Apple, wherever you listen to your favorite podcasts. Look up Lumida Non-Consensus Investing. Vishal, how can people learn more about Better or follow you?
Go to better.com.
There you go. Simple call to action. Take notes, people. All right. Take care, everyone. Have a good one.
Thanks so much. Cheers. Take care.
Bye. Awesome. That was